Friends, to another edition of the Heritage Wealth Planning YouTube channel. Today is going to be a fun topic we're going to talk about. It's going to be a follow-up to my podcast that I did where I said how Monte Carlo analysis is crap and what you need to know to fix it. And that's where we're going to dive in here today. So let me get myself minimized here. Hopefully, yep, there I am. Sweet. You can still see me here. This is firecalc.com. It is by far the best retirement calculator I've ever found in my life. Now, I've been using this for a long time. There might be some more stuff out there now that I haven't kept up to snuff with, but this is just absolutely dummy right. Completely suitable for everything I've ever wanted to do when it comes to financial planning and retirement calculators. Only drawback that doesn't take taxes into consideration, and that's where other more engaged software can. But this is completely free. You can donate to the folks who run this, as you should if you use it as much as I do, but firecalc.com. So let me tell you exactly what happens here. And they're starting with a premise. They're using this three scenarios: red, blue, and green. Red is bad, green is good, and blue is okay. And they're going to tell you, averages don't tell you much at all when it comes to investments. Retire in the early 70s, starting with $750,000 and taking out $35,000 on each year. And on average, you'll do just fine because $750,000 or $35,000 on $750,000 is only 5% a year. So on average, you do fine. You average 5% a year, you're going to be fine. However, if one starts retiring in 1973, one in 1974, and one in 1975, look at the huge divergence between the three, just due to luck. The one who retired in 1973 ran out of money in 20 years. The one who retired in 1975 still had that's almost $2 million after 30 years after. That's 29, 30, 31, 32 years, taking out $35,000 a year adjusted each year for inflation. The one who retired in 1974 was a little bit underwater, but still had money after 32 years, again, adjusted for inflation. If this was you in the red, you did nothing wrong. You just had bad luck. If this was you in the green, you're not a genius. You just had good luck. It's just all there is to it. Luck dominates retirement planning. Luck dominates retirement planning. So given these numbers, financial planners, we have the Trinity study from Trinity University in San Antonio, which came out in 1997, which is based on Bill Bengen's research from 1994, which said the 4% rule. The Trinity study kind of confirmed that. And most plans have basically kind of fallen right around that 4% rule methodology, which is great from a circumstance of how much can I safely withdraw from my portfolio without really risking run out of money, as long as my portfolio is moderately aggressive or moderate. Basically 60% stocks, 40% bonds, maybe 50-50, 40-60, maybe that concerns me some. But basically moderately to moderately aggressive portfolio, you can take 4% a year out, thus the 4% a year rule. I absolutely agree with that. But here's the problem. And this is why I say the Monte Carlo analysis that everybody's been telling you about is wrong, because what it doesn't do, it doesn't take the two biggest expenses you have on your portfolio. And those are investment fees and taxes. Investment fees and taxes. It completely ignores those. And I don't blame the software producers for that. The software producers doesn't know what your investment fees are going to be. They don't know what your taxes are going to be. So the software producers who run the Monte Carlo, which is just a systematic sequence of returns, or basically random sequence of returns, statistical analysis, not systematic, random sequence of returns. And I'll get more into that here in just a second. They don't know what your investment fees are going to be. They don't know what your taxes are going to be. The third problem with Monte Carlo is the rates of return they're using. Are they using fake rates, or are they using historical rates that we can actually hang a hat on? I don't know. Some softwares, I know for a fact, do some crazy historical rates that just are not applicable today. Folks like FireCalc, they just use historical numbers, and they use that going forward, and I absolutely find that to be appropriate. And so that's the third thing with Monte Carlo is what are they using as the rates of return to project that into the future. All right, so let's show you what these guys do, because I find it incredibly fascinating. Now, what I love about this is that we can actually add investment fees to the portfolio to show you the difference that a simple fee can do in terms of your ability to maintain your retirement spending. Now, a couple things here. I'm going to use this. We're going to spend $30,000 a year on a $750,000 portfolio and we're going to do it for 30 years. That's just 4%. That's it. You can do whatever you want. You want to do 5%. You can do whatever you want here. You want to do it for 40 years. You want to do it for 20. You want to take 10,000 a year out. Take 100,000. You can do whatever you want. It's completely up to you. And what I'm going to do, though, is we're not going to hit submit yet. So what we're going to do is we're going to go into some of these methods here, and we're going to do spending models first and foremost, because the spending models are critical. How much are we actually taking? Now, the first question people ask is, well, what about Social Security? At this point, I don't care, because all I'm saying is I have a $750,000 portfolio and I need $30,000 a year from that. It has nothing to do with Social Security. And the reason I might need $30,000 a year is because that's my income gap I have from what I talked about yesterday. And I'll link to it right there on what is my income needs versus what is my Social Security PIA. Remember that PIA, primary insurance amount, is the Social Security I'll get at my full retirement age. So my income needs, subtract out my Social Security that I get, and that gives me this gap. So what we're saying here is that gap is going to be $30,000 each year. Okay, now we're going to adjust that for inflation. So we're going to say in this year one of my retirement, my income gap is $30,000. Whatever my Social Security is not enough. I need $30,000 from my portfolio, and now I happen to have a portfolio of $750,000, $750,000. So the question is, can that maintain itself for 30 years? So let's click on other income spending. Let's click on spending models, because this is critical. And we have a couple different ones here. And again, I've talked about my man Ty Bernicki and his reality retirements plan that he wrote in the Journal for Financial Planning in 2005. I tell you, it just completely blew the doors off the retirement planning industry. Some people challenge it. Some people, it doesn't matter. At the end of the day, there's a lot of legitimacy to Ty's research. Lots of people have come forward since then over the last roughly 15 years and validated, if not the entirety of it, the majority of it. And all that simply says is your spending is probably going to go up a little bit when you hit retirement, and then it's going to start falling. We're not even going to use that. I think you should, because it is reality-based, but we're not going to use that because we kind of want to show the worst-case scenario here in this analysis. So what we're going to do is we're going to use the first one. It's constant spending power. I don't really use this last one, adjust your spending depending on the value of your portfolio each year. That's actually probably a pretty good one to use on occasion. And some of that says, look, we call the belt tightening mechanism. If your portfolio is down 10% a year, we're going to make sure we reduce our withdrawals by 10% that year. Some guys in the Journal for Financial Planning, drawing a blank on who wrote that. There's a good article actually 10 years ago, belt tightening. I can't remember what he called it. I don't think it's called the belt tightening. But anyway, a pretty good article in that regard about basically if you have this band that says the markets are down, I'm going to take a pay cut of 10% of my income needs for my portfolio. You'll be fine. Man, I wish I could remember who that guy who wrote that. It was a pretty good piece. That's a little bit too complex for me because I think at the end of the day, the constant spending power versus Ty Bernicki's is just all we need. But we're not going to use Ty Bernicki's because that is, again, an optimistic model. The percentage of remaining portfolio. Let's see if he doesn't. No, he doesn't talk about the author of that from the Journal for Financial Planning. We're just going to use a good old-fashioned rule of thumb, 4% a year off your current portfolio, adjusted each year for inflation. We're using inflation. We can change the numbers around any way we want. We can make it hyperinflation like 1920s Germany or current Venezuela. We can do whatever we want. I'm just using the historical U.S. numbers for inflation, cost of living adjustments. That's it. So we're not making anything fancy. We're just using the historical numbers here, but you can change any way you want. There's a lot of different models up in here. All right, so we're going to use the constant spending power, and then we're going to say our portfolio. Now, here you can do all kinds of different things. And I'm just using a total market, which goes back to 1871. Now, back then, basically, there wasn't that many stocks. It was mostly large companies. That's it. But it does give us a 150-year track record of total market returns in the stock market. I mean, because there's some bad years back then for sure, as well as there were in the last century, as well as there's been in this century too. And so going back to 1871, again, it's a very concentrated group of U.S. stocks, but it's a good place because that is a history of the U.S. stock market for sure. And if you can last from 1871 till today, you're probably in pretty good shape. I would even argue that the market, the way it's structured today, is actually even a little bit more abundant simply because you can diversify more. You have small companies, international companies, emerging markets. You have value-oriented. You got mid-caps. You got commodity. You got real estate. All kinds of different ways to manipulate a portfolio. And you can do that down here. You can say micro-cap, small. And again, it's just based on historical numbers. 1926 is typically the real modern era of small, large treasuries, cash, and things of that nature. 1871, if you look at Jeremy Siegel's work, that's where he goes back to 1871. He's over at the University of Pennsylvania, Wharton. So lots of research. I don't want to do all that. That bores me to death. I just like to read what they have written or what they have researched. You can even go with random performance, all kinds of different ways to do your methodology here. This is the big one right here. So for what we're going to do in this example, we're going to do the total market. We're going to have, going back to 1871, we're going to have 75% of our portfolio in stocks, the total market. Actually, no, let's do 60% because we're doing a 4% a year rule. We're going to model on the 60-40 stock to bond mix. So 60% of our portfolio is going to be stocks. 40% is going to be on, and I did check this, long interest rates. So that's going to be the long bonds, the 30-year bond. We've got 30-year treasuries, we've got 5-year treasuries, we've got commercial paper. 30-year bonds are going to include corporates and governments, which is a little bit more of a reality model when it comes to bonds. But you can do whatever you want. You can do treasuries, commercial papers, just CD rates, a little short term. I wouldn't do that. But you can, again, whatever you want to do. But so in this case, our model is going to be 60% U.S. stocks, 40% U.S. corporate and government bonds that have the longer interest rate, basically a 30-year maturities. All right, so that's where we're going to be here today. Now, this is the big one, my friends. What's the fee that we're paying? And right now I'm using 18 basis points. That's basically 1/5 of 1%. We're going to say it's costing, we're investing at Vanguard and there's no other fees at all. It gets rebalanced annually, by the way. Nothing, I don't do anything. I don't push a button or nothing. It just happens on its own. It gets rebalanced annually. We're not assuming any taxes in that, which is a big problem, but we'll talk about that different scenario, a different YouTube thing about how taxes can crunch you. But the investment fees can, and we are going to show you how the investment fees change. All right, so again, let's go back to the scenario. $750,000, you're going to take $30,000 a year. That's 4%. We have a 60-40 stock to bond mix. We have a track record going back to 1871. It gets rebalanced every year, and we have expenditures of 0.18% because we're using Vanguard index funds. Follow me so far? We can include other spending models. We already talked about spending models. We're going to spend each and every year adjusted for inflation. It's going to increase. You can do other income spending. You can do not retired. These are just if you're adding to your portfolio. These are if you want to use Social Security as part of the mix, and I don't. I just want to see if the 4% rule will last. Portfolio changes. If you have a big lump sum, you want to buy a house in 2 years, you can take $200,000 out. You can do all that. I'm not doing that here today, but you can. And then you can run different investigation models. And again, I like this one right here. How do fees impact the success of a retirement plan? Investigate change in asset out. You can do all this right here. I'm not doing any of that. I just want to keep it simple, stupid. And so we go back here and we hit submit. And what's going to happen is, see this chart up here is going to give us the results. So let's see what the drink of water. All right. So here's the result tab. Your spending in every year after the first year will be adjusted for inflation, so the spending power is preserved. Capital preservation or purchasing power preservation is what we're shooting for here. Look at all these things. They're running. So let's just read it, actually. I'll just read this to you because it's fascinating. FireCalc looked at the 117 possible 30-year periods. So again, 1871 to today, and they're going to use 2017. There's 117 different scenarios. You retired in 1871, you retired in 1872, 1873, so on and so on. There's 117 different scenarios of 30-year track records of when you retired. You start with a portfolio of $750,000, and you're spending each year $30,000 initially adjusted for inflation. How your portfolio would have fared in each of the 117 cycles. So each of these represents one of those 117 cycles, each of these line graphs. The lowest and highest portfolio balance at the end of your retirement was negative 204 and positive 3.4 million. So the lowest and the highest of the 117 scenarios, you lost 204,000, you were bankrupt. or you had $3.5 million. You were living large. The average was 1 million. Okay, so the average was $1 million. And again, that's looking at all the possible scenarios. Values are in terms of the dollars at the beginning of the retirement period for each cycle. For our purposes, failure means the portfolio was depleted before the end of the 30 years. So you ran out, your portfolio expired before you did. And Fire Calc found in this time only 5 times did you run out of money. That's it. Thus, the 4% rule proves itself once again. 5 times did you run out of money. 95 times, 95.7% of the times did you have money left over. And you had money left over on average $1 million. All right, so pretty good. That's pretty good. If that was you, you're pretty happy about that. You're not taking on too much risk. You had money left over, not very high probability, in fact, none at all, that you're going to run out of money based on historical numbers. Let's dabble a little bit. Let's change the fees around. So I'm going to come back to your portfolio because a vast majority of us are not paying 0.18. I'm going to say 1.5. Now, that's your all-in fee. Don't forget, mutual funds have expenses. If you're hiring some guy, he's got expenses. So there's expenses all over the place in the investment industry, which is why Vanguard has made such a headwind, or well, I don't know if that's the right word, but made such hay, because John Bogle from Vanguard says we got to return the investment risk back to the investors so they can, not the risk, but the returns of the investments back to the investors because they're taking all the risk. And when we're getting 1.5% fees, a good portion of the investor returns are going to the manager, not the investor, but yes, the investor taking on the risk. So now all we've done here right now, my friends, is we changed the fees from 0.18 to 1.5. Let's see what the difference is. Now remember, before it's 95.7% chance of success. Oh, look at that. It dropped significantly. Success is now 74.4 from doing nothing else but changing the fees from 0.18 to 1.5. Look at that. So here we have 117 possible scenarios. Let me move my face out of there again. Let's see. 30 of those 117 you failed. 30, which means you had a success rate of only 74%. Now, on top of did you fail a whole bunch more, but the highest loss you had was negative 525, which will never happen because you ran out of money well into as you start retirement, and your highest portfolio value was not $3.5 million, it was $2 million. And the average at the end was only $478,000. Again, half of what it was in the other portfolio, from nothing else changing other than the fees. And just again, here's 117 different lines on the line graph, and look, not the majority, but a good percentage did not make it above zero. A good percentage did make it above zero. You ran out of money. This is the average right there. Krakow. A few were up here, a lot were down here, and a couple were in the mean right there in the middle. That's tough. And that, again, that doesn't include taxes, my friends. That does not even include taxes. That just includes the investment fees. When you factor in taxes, it's going to be even worse. So let's do something else. Let's go over here. I'm going to show you something. So now we're going to go, not portfolio change, investigate. Yeah, let's click on this. Let's see, impact of fees on investments. So let's hit submit, and let's see what we come up with. A nice little Excel spreadsheet here. Watch this, a Excel graph. So all this is saying, if my investment fees were nothing, this is zero for fees, I had a 96% retirement probability, of success probability. If my investment fees were 3%, I had a 51%. And you can see as the fees get higher, the likelihood goes down. Here's 1.2, which is the average mutual fund fee before advisor fees. All right. And that has about an 80% success rate. Again, this is before taxes, my friends, before taxes. 1.2%, 1.2 is my fee. My success rate is less than 80%. Throw in taxes can be significantly lower than that. I went to 1.5 roughly, and there it is, right about there. It's, right at 74.4% is my retirement success probability just because of fees alone. So let's go to another investigation. What if we change? I haven't done this yet. It'll be interesting to see. Change the allocation and kept the fees where they were, 1.5%. Let's hit this guy here. and we're going to hit Krakow over there. I don't know what's going to be interesting to find out. So you're with me on this. So here, if we change the allocation, 0% stocks to 100% stocks. Let's see. How is success rate effective? The chart shows 0% stocks at the left, 100% stocks on the right, and the y-axis is the success rate. Okay, so good. So what this says here, if we don't have any stocks, we still have 35% success rate, which actually is a little bit more I would have thought. But if we have 100% stocks with a current fee, we never break 84% success rate. So again, the fee is the biggest detriment to making this thing last. So if you have a fee of 1.5%, you can have all stocks in the world you want. You're not going to increase your rate of return in terms of your success probability at all. In fact, here we go here, basically from having 80% stocks, still going to, look at that. I mean, you can go from 80% to 100%, and your success rate doesn't go up hardly at all. I mean, you can be here, what's that, about 70, I guess, 75? Yeah, probably 75%, and 2/3 of your portfolio is in stocks. And if you say, I need to get more, it's not going to change much. The biggest thing that you can see here, I mean, so let me just reiterate that. If I have 2/3 of my portfolio in stocks, and it gives me a 73% potential success rate, which is what we saw actually. So 73% success, that means 73% of the time I was successful, 27% of the time I failed, which is a little bit lower than what we like to see. We have two options. We decrease our fees or increase our portfolio stock bond ratio. Well, if we increase our portfolio stock bond ratio without decreasing our fees, our probability of success doesn't go up much at all. It's still, that's probably 80 right there, maybe 82. It goes up from 74 to 82. That's not a big deal at all. On the other hand, watch this though. If we reduce our fees, no, that's not what I want. Fees right there. How do fees impact? Watch this. So we know increasing the exposure to equity stocks in that static fee doesn't do anything. A little bit, but not much. Conversely, if we reduce our fees from 1.5 to just 0.6, we reduce them to 1.5 to 0.6, our success probability rate goes above 90% from 74. So that's a 20% increase just by reducing fees. Even if we only reduce the fees to say 1%, which I guess is probably right there, we're still looking at an 85% success rate, whereas before it was only 74%. And once you hit 85%, we're pretty comfortable in the financial planning community that you're going to be okay. That's pretty significant. It just shows you the impact of fees. Now, other software that I have that I buy into, I pay for, will show you the impact of taxes, and I'll get on that in another video. But this just right here shows you the impact of fees. It's brutal. It's brutal. Unfortunately, because a lot of fees are hidden, you don't get an invoice for them. You never see them. Mutual fund fees, you don't get invoiced. Now, investment management fees, you do. All right. So investment management fees, you don't get an invoice, but you see them coming out of your account monthly or quarterly. So as long as you look at your statements, you're going to see them, but you never get a bill in the mail. You owe me $3,000 for investment management. It doesn't ever work like that. And I wish it would, because if it did work like that, people would be up in arms. They say, I don't want to pay that, which is a problem actually with financial planners. We're sitting there thinking, we don't want to charge investment management fees, but we also recognize a lot of people don't want to pay by an invoice and pay a check for financial advisory services. They'd much rather have it deducted from their account, even if it's going to hurt their portfolio, it's simply because out of sight, out of mind. And that's just, I wish there were a better way to explain it, but there's not. Because the facts are investment fees are one of the two biggest detriments you have to portfolio success, without question. The other, of course, being taxes. And if you're going to hire a financial advisor and she's going to charge you 1%, and they're going to have you in various mutual funds and whatever it is, it just makes it that much harder to have a successful portfolio. It really does. Ideally, you'll just pay for that advice out of pocket. But again, that's tough. People don't like to get those bills. They don't like to see it. So they much rather have it just billed as through investments, which they don't see it, which is unfortunate. But that's the way we are today. So Anyway, remember, investment fees can play a huge role in your probability for success. Investment fees are not in the Morningstar. They're not in the Monte Carlo analysis necessarily that you get from your investment firm. And if they're not showing you investment fees and they're showing you some pretty good numbers, you got to step back and say, that's great, but let's throw the investment fees on there. And even if that means you got to reduce their projected returns by 1%, you need to do it simply because that is more reality based than just simply showing you what the market did as a whole without fees, because no one is getting the market as a whole without fees if they're hiring an advisor. No one is. The only way you can do that is you buy a mutual fund or an index fund or an ETF. Either of those have a little bit of fees, not much. TSP with the feds, the government, military and whatnot, the federal employees, those don't, the fees are just incredibly low. Even those have a little bit of fees. It's like 3 basis points. You can't get any cheaper than that. But at the end of the day, there's still a fee. That's the cheapest you can do. And if you're not showing it in your Monte Carlo projections, your Monte Carlo projection is going to be way, way, way too optimistic, which could hurt you big time when it comes to your retirement planning. So just be advised, you heard it here first, investment fees need to be accounted for in your retirement planning scenarios. All right, folks, so I hope this helps. Questions, comments, concerns, put them down below, please. A thumbs up, like I say every single time, I'm going to keep reminding you, thumbs up. That helps YouTube to recognize the content and that people are actually watching it. Share the video. For heaven's sake, share it. Sharing does too as well. It just occurred to me I haven't been telling people to share the video, but please do. That helps again. Anytime there's any kind of thing that pings YouTube that something's happening on the Heritage Wealth Planning YouTube channel, it makes them more inclined to promote the content to others. So anything you can do to help me, I'd certainly be appreciative. Subscribe, hit notification button as we talked about, that bell as we talk about all the time, and we'll see you next time on the Heritage Wealth Planning YouTube channel. Thanks, guys.